Welcome, fellow investors. I'm excited to share invaluable insights from some of the greatest minds in the world of finance. From Warren Buffett to Carl Icahn, we'll hear straight from the legends themselves. So get ready to take notes because their strategies are sure to give you an edge in navigating today's market landscape. And while you're here, be sure to like and subscribe so you don't miss any money-making tips. Number 1. Invest in what you know. Warren Buffett. Warren Buffett is a name that's all over the financial news, and unless you've been living under a rock, you've probably heard of him. With a net worth exceeding a staggering $100 billion, Buffett is practically a financial deity. But this man isn't just wealthy in money, he's also rich in investment wisdom. One of his most famous mantras is, "Never invest in something you cannot understand." What does that mean? It means really learning about companies before giving them your money. Figure out what they sell, who buys it, and how they make a profit. Read their yearly reports to see how the business works. You can even talk to friends in related industries. When you understand a company, you avoid investment pitfalls. Some easy ones to research are brands you use every day like Apple, Coca-Cola, and Amazon. Getting familiar helps you spot good investments. As Buffett says, only invest in what makes sense to you. Number 2, mistakes are inevitable. Peter Lynch. Peter Lynch, who managed a big investment fund at Fidelity, made an average of over 29% profit every year. Yet even this luminary of the investment world admitted that making mistakes is inevitable. He famously remarked, "In the business of investing, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. Lynch believes that making mistakes is a natural part of investing. By accepting this and not being afraid of it, we can grow and become better investors over time. So, don't let mistakes scare you. As long as you learn from them, you'll make smarter decisions down the road. As Lynch wisely advises, be ready for mistakes and they won't stop you from reaching your goals. Number 3. Be patient. Prince Alwaleed Bin Talal. You might not know his name, but Prince Alwaleed Bin Talal is a big deal in the investment world. He emphasizes the importance of investing with a long-term perspective, asserting, "I'm a long-termer, I'm not a seller." His lesson is that enduring short-term setbacks is part of the journey towards success. As the owner of luxury hotels and a stakeholder in companies like Apple, Twitter, Snap, and Citigroup, he highlights the importance of maintaining investments over an extended duration. What does that mean? It means having a plan to hold investments for 5, 10 years or more. Don't panic and sell when prices dip short-term. Give your stocks time to grow over the long run. With patience, your money can really multiply. Number 4. Diversify. John Templeton. John Templeton was extremely successful on Wall Street in the mid-20th century, and he knew that spreading out your money among different types of investments is crucial for investors. He wisely noted, "The only investors who shouldn't diversify are those who are right 100% of the time." Diversifying your investments means spreading them out across different parts of the market and possibly different types of assets. You can diversify easily by putting some money in large companies, small companies, bonds, real estate, and other areas. Even just dividing between a few low-cost mutual funds gives variety. Diversifying is a simple way to make your money more stable over the long haul. Number 5. Forget about cash. Ray Dalio. When it comes to money matters, Ray Dalio, a big-shot investor and founder of Bridgewater Associates, puts it bluntly, "Cash is trash." Dalio's perspective highlights the potential pitfalls of holding excessive cash, as its returns often fail to outpace inflation. Just keeping piles of money sitting around doesn't help you much. In fact, after taxes and inflation, your cash slowly loses value over the years. Instead of leaving it idle, Dalio says to put it to work through investments. Stocks, bonds, real estate. Historically, these go up more than 2% or 3% per year on average. So those assets are better than cash collecting dust. Number 6. Have a plan. Benjamin Graham. Benjamin Graham points out the importance of having a financial plan. In his own words, the best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. In the late 20th century, Benjamin Graham was one of the first to teach intelligent stock investing. He knew setting clear goals was vital. Graham believed that the real test isn't beating the market, but about reaching your own goals. Have you thought about what you truly want? Like retiring comfortably, the travel you dream of, the kids' college funds? Once you know destinations, map out the road. Decide how much to contribute each month from spending or raises. Choose where to put it. Low-cost index funds perform well long-term. Follow a plan and you'll be well on your way. Number 7. Master your emotions. Peter Lynch. The trick is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them. Peter Lynch remarks, "Stand by your stocks as long as the fundamental story of the company hasn't changed." Peter Lynch knows emotions can mess with good investing. He says don't trust what your gut is feeling. In fact, try ignoring feelings. Why is that? Well, fear and greed cause people to buy high and sell low. When a stock drops 20%, panicked emotions tempt you to sell, just as it may start rising again long term. Lynch advises sticking with companies as long as their underlying business story remains strong. It takes discipline, but blocking out anxiety and excitement leads to better returns in the long run. Number 8. Gain historical perspective. Carlos Slim. Carlos Slim is one of the richest people in the world thanks to his investing acumen. He built a fortune transforming telecom industries across Latin America. Slim believes that understanding history is key for the present. As he says, with a good perspective of history, we can have a better understanding of the past and present, and thus a clear vision of the future. For investors, studying market and economic history can help identify repeating patterns. This grants perspective during volatile periods and the foresight to anticipate coming opportunities. Set aside some time daily to research historical market crises, booms, and the policies that influence them. Read biographies of legendary investors. Having this knowledge in your back pocket can really boost your performance. Number 9. Adapt to market changes. Michael Steinhardt. As the founder of hedge fund Steinhardt Partners, Michael Steinhardt earned an average annual return of 30% over a 24-year career. He's considered one of the greatest traders who ever lived. Michael Steinhardt's advice for us today is to adapt to evolving market conditions. He once said, "The markets are always changing, and the successful trader needs to adapt to these changes." New technologies, regulations, economic cycles, and geopolitics constantly influence supply and demand dynamics. To adapt, Steinhardt remained a voracious learner, always educating himself on emerging trends. Investors today can also evolve with the times. Follow diverse sources to broaden your perspectives beyond your comfort zone. Experiment with different types of analysis and reevaluate positions. With open-mindedness, you'll be ready to profit during unexpected market changes. Number 10. Let winners run. Dennis Gartman. Dennis Gartman was a well-known financial analyst. For over 30 years, he wrote a daily newsletter called The Gartman Letter that big investors read every morning. Even after retiring in 2019, Gartman still shares his thoughts on the markets. Gartman had a good rule. Be patient with winning trades, be enormously impatient with losing trades. Remember, it is quite possible to make large sums trading investing if we are right, only 30% of the time, as long as our losses are small and our profits are large. His quote points out a common mistake for new investors. First, don't sell too soon when a trade starts paying off. Let it keep making money. Second, don't wait around when a trade goes bad. Cut your losses short. As Gartman explains, you don't need to be right most of the time to do well investing. The key is letting your winning trades run while dumping the losers before they cost too much. If you do that, you'll end up making more money overall, even if you're only right 3 out of 10 times. That wraps up our look into the invaluable wisdom of the world's top investing legends. By following these 10 invaluable tips, you'll be on track to achieving exceptional financial success. If you found value in these revelations from the greats, show your support by smashing that like button and subscribing to the channel. It really helps me out and I appreciate you joining me on this journey to stock market mastery.